Hey guys, what's up? This is a strategy masterclass that goes into 5 different strategies to help you profit in any phase of the market, uptrending, downtrending, sideways, whatever. It's going to help you profit. This is going to be one of the most comprehensive strategy videos you have ever watched on YouTube and ones that I have ever made. So if you're an options trader or a credit spread trader, or you're an absolute beginner and you want to have a strategy and trading strategy that has a historical win rate over the last 15 years to make sure that you make money, I'm going to walk you through each one of these strategies, what market it works in, what stocks it works best on, and step by step how to trade it. So again, close out all distractions, grab a notepad and a pen. You're going to want to pay attention and probably watch this a few times. If you truly understand and apply these strategies in this video, you can grow your small account quickly. You can build a side income for you and your family, and you can even turn this into a full-time job if you really want to, because that's what I do as well. All right, guys, thank you for tuning into this video. Please put away all distractions and focus. This is going to be a great video. All right, guys, enjoy. Hey guys, what's up? I'm going to show you how to use credit spreads and this strategy to make to have a 90% win rate on all your trades. I'm going to show you how this is back tested, how the theory works, and step by step how you can do it yourself, so that you can actually, at the end of this video, have a strategy that you can actually apply for yourself, but not only apply and use, but something that you understand. So let's jump into how and why this works. So if we want to look at the back test of this specific strategy, you can see here it's the squirrel strategy that we're going over today. On the S&P 500 has a 90% historical win rate. You can actually look at all the past trades for this over the years, all the way back until 2003. You can see here, again, if you want to kind of slow down the video, you can look, it's actually all the way back till 2007. You can see here all the results we have with this strategy. Again, it works, and it works not only for SPY, but it works for all the major options trades you could do, or options symbols. We have DIA at a 91% win rate, IWM an 85% win rate, GLD a 93% win rate, and TLT, the bond market, a 96% win rate. Now, why is the win rate so high on this credit spread strategy? Well, let me walk you through the theory, and then I'll show you step by step. So the theory behind this trade is quite simple. When we look at a market can only be in one of 3 different phases. The market can either be trending up, which means it's moving higher, which means highs are getting higher and lows are getting higher as well. Or number 2, we can be in a downtrending market, which is where the highs are getting lower and the lows are getting lower as well. But number 3 is a neutral market, sideways, and the market is doing nothing. When the market is doing nothing, that means anything can happen. It can shoot up one day, it can shoot down one day. There's no clear direction. And so this strategy plays off a sideways market where there is no clear direction. And so again, how do we measure that? Well, we can measure the market being sideways by one of 2 ways. One is we can look at the highs and lows. Are they roughly the same? Are we staying within a trading range? So for instance, if I were to draw what I'm currently seeing here on the chart, you can see how I have a high here. And if we look at the S&P 500 against on the daily chart, that's where you should be drawing most of your lines, we have a high and low here. And now the stock is staying between this line. It's not making any higher highs. It's not making any higher lows. But at the same time, mathematically, we can look at it and see that the stock is just not moving, but also it's within this gray area. And this gray area is known as a neutral market. Again, if you want access to the trending band indicator, again, you can click below to get access to it, but it's a custom indicator that I programmed on TradingView. Anyways, we look at this, and if we're in the middle, that's when we execute this. Why? Well, because the market can't do anything. We're going to go out to a roughly 15 delta, or roughly 4% below the close, and put on a put credit spread. If you don't know what a put credit spread is, it simply means you make money as the stock stays the same or goes higher. So again, we'll be looking at the stock. We'll be entering in around the 200-day moving average. And then from there, we'll be looking to put on put credit spreads 4% below the price. And so the reason why this works is because net neutral in the long term, the market, the Dow Jones, the S&P 500, gold, etc., they are all bullish stocks, bullish ETFs, bullish indexes, which means long term they're going to trend up. So even though we're in a neutral territory where the market is going sideways, there's still a bullish sentiment. And so with that, we place put credit spreads to make money to the upside. And with that, that's how we're kind of capitalizing on this. But in order to give us an extra range of safety, we're going out 4% below the price. And that's kind of how we do that. Now, let me show you step by step. Here is the strategy. If you want to take a look at this article that I wrote about the strategy in depth, the reasoning behind it working, etc., and the step-by-step instructions,
you can click the link in this description, the description of this video. But anyways, I'll walk you through it. Step number one is we want the market to be sideways. Sideways meaning that, again, it's not making any higher highs or any higher lows. It's just staying sideways. Again, we can see that mathematically by looking at it being +1 and -1 standard deviation of the 200-day moving average. Number two, once we know the market is sideways, then we know the strategy is good. We're going to move on to the next step. We're going to wait for the market to close. And once it closes, we're going to go 96% of the current stock value. So if I look at the current stock value being 403.70, again, I'm just going to pull up my little my calculator and go 403.70, multiply that by 96% or 0.96. That gives me 387.55. We're going to round up to the nearest whole number. So that's going to be 3. So that means I'm looking for a put credit spread where I'm selling at 3.88 as my strike price. Next, we need to determine the next one. So if I'm selling the 388 strike, then I'm going to buy the one right below it, so the 387. Now, what is my expiration date? Simply put, my expiration date is the current date. So for instance, today is March 30th plus 14 days, and then round up to the nearest Friday. So again, from right now, this is almost the end of March, it's going to be roughly April 14th. April 14th is a Friday. That's going to be our expiration date. Now, we're going to set up the trade in our broker. So now let me just actually pull up Robinhood right now. So this is an easy platform to use. I'm trading credit spreads on a small account here, but I also have a large account with Tasty Trade that's roughly 6 figures. But anyways, if we go into SPY, we go into our stock, we go into our trade SPY options. Using everything that we determined, you can either set the trade yourself or go to Builder, which I like, Builder, and go to Put Credit Spread, which is this, or a Put Vertical Spread, whatever you want to call it, right here. Then we're going to go to our expiration date, which we determined to be April 14th, right here. And then we're going to go a width of $1. And then we're going to go, what was our first strike price that we calculated, which is the close price times 0.96. That's 388. Go here, 388, 387 right here. So now we can enter this trade for roughly 11 cents. Now, again, in order for the numbers to work out long-term in our favor, what we want to see is we want to collect at least 15 cents. So if we can't collect 15 cents, then we're not putting this trade on. That's the next step. Ensure you can collect 15 cents in credit for putting on this put credit spread. If you can collect 14 to 15 cents, then put on the trade. If not, wait for the stock to drop and then re-enter when you can get at least 15 cents of credit. Now, again, that is how you put on this trade, and that is the statistical backtest of how we got a 96% win rate on TLT and a 90% win rate on SPY. And again, you can see that backtested all the way back to 2007. It's exactly how my members do it, except my members get alerted exactly when these trades occur. You can see here the most recent one on SPY was a 383.79. This trade is currently sitting at an 80% profit on the trade. So anyways, that's how this trade works, and it's very simple to put on. Again, if you want to see the specifics behind it, you can click on the description below to check out this article that I wrote. But I just want to clarify, in order to make this trade more accurate and to increase your win rate, you want to do a couple things, which is the special criteria right here. Number one, wait until the market has been inside the trending band for at least one day. Make sure it's sideways. Confirm that it's sideways before you enter the sideways strategy. Number two is make sure the daily change is less than 0.5. Don't enter when the stock is super green. Why? Because when the stock is super green, it's going to be really hard to collect that 15 cents in credit, and you give yourself way more room for the stock to drop in the future. Again, this is a sideways market, which means it can do anything. So if you're in a sideways market, you're more likely than not going to experience a red day at least once a week, if not 2 or 3 times a week, because of how volatile it is. So just wait to enter on a red day, because that's when you're going to get the highest premium, and that's also going to increase your max profit and decrease your max loss. Anyways, if you want to learn more about how you get these alerts sent straight to your phone so you never miss out on one of these trades, you can check out my 10% credit spreads Inner Circle program linked below. But if not, regardless of whether you sign up for any of my programs, this strategy will help you make money every single week using put credit spreads in a sideways market. If you want to learn more about my other strategies, smash that subscribe button because I have so many more coming. Thank you for watching, and I'll see you in the next video.
Hey guys, what's up? I want to show you exactly how to have a 90% plus win rate when trading put credit spreads. This strategy is designed to help you make money in uptrending markets. I'm going to show you a back test to prove to you that it works. I'm going to explain the theory behind why it works so you can understand it, so you can understand what you're trading. I'm going to show you the best stocks it works on and step by step how to place this trade so that every single week you can place it and consistently make money. So let me walk you through step one, which is the back test. You can understand how this works. So if we come here to the back test, you can see here on the S&P 500, it has a 92% win rate. Now that is the beauty of using the strategy. If you can have a 92% win rate, then you're going to be doing very, very well when it comes to credit spreads. That's why you have a 295% yearly return back tested since 2003. Now it also works well on DIA. DIA has a 90% win rate with roughly a 295% yearly return as well. And so that's the beautiful part of the strategy. Now again, it also works on IWM, GLD, and TLT, but they have roughly an 85 to 86% win rate. Still wins, but again, not as high as SPY and DIA. So I just wanted to make sure you know the best stocks that this works on. And it's also great because SPY and DIA are very liquid option stocks. You can get in put credit spreads with no problem. All right, next, let's explain the theory behind why this works. If you don't know this yet, there's only 3 phases a market can be in or a stock can be in. Number 1, it can be in an uptrending market. What is an uptrending market? It is where the stock is continuously going higher. That is defined by higher highs and higher lows. This is an uptrending market right here. Number 2, it can be in a downtrending market, which is the opposite, where the stock is going lower. That is defined by lower highs and lower lows, where the stock is moving lower. And number 3, it can be in a sideways or neutral market. That is where the stock is staying within the same range. And how do we identify that? Well, when the highs are roughly the same and the lows are the same and the stock is going nowhere over multiple months, that is a neutral or sideways market. Now again, what most people on YouTube and most trading gurus don't tell you is they're like, this strategy works, but it only works in one of those 3 markets. And if you trade a strategy outside of the market it's designed to work in, you're going to lose money. So I want to tell you, this strategy I'm teaching you today, the True Turtle strategy, is built for uptrending markets. So do not trade the strategy unless the market is uptrending. Now you may be asking next, well, what is an uptrending market? Well, I just gave you a definition for it with higher highs and higher lows, but if you want to add an indicator on the chart to see it, put on the 200-day moving average line. That's this gray line right here. When you put that line on, you can see if the market is trending up or trending down. The industry regards any stock above the 200-day moving average as a bullish stock and any stock below that line as a bearish stock. So that's how that works to identify bullish and bearish tendencies. So why does this work? Well, because put credit spreads make money as the stock goes up, makes money if the stock stays the same, or makes money if it comes down a bit. So when we're combining a bullish directional option strategy and an uptrending market where the market typically goes higher, then we can have a win rate of 92%. So let me show you exactly how to set this trade up now that you've seen the back test, now that you know the theory behind trading with the trend and understanding the trend is your friend and you just follow that with the put credit spreads. Now I'm going to show you step by step how to put this trade on. All right, so let's go into the specifics. If you want access to this article right here, it's going to be linked in the description below, but I write an article for every single strategy that I backtest, that I work in, that I use, so that one, you can understand why it works, but also do it for yourself. I'm giving you this strategy completely for free in hopes that you make money with it like I am, and then with that money, you join the 10% credit spreads inner circle program where I work with you exclusively. Again, it's a super cheap price for the amount of value you get. You also get access to my text, email, and Discord alerts in real time on both my small and large account, and you just get instant access to these trades. So if you work full time, you don't have to worry about missing out on these trades. Anyways, let's structure how to set up this trade. So this trade, again, the bullet point number 1 is all about waiting for an uptrending market. Make sure the stock is trending higher. So again, that's going to look like waiting for the stock to break above this green line, which shows us that the market is uptrending, which is +1 standard deviation of the 200-day moving average. Next, you want to determine what your put credit spread strike prices are. So if you never placed a put credit spread, I made a video on it before, which I'll link somewhere around here. But anyways, you want to make sure your stock close price is that you multiply that by 97%. So let's take this for example, the current price of today. Let's assume the stock is above this green line and that the current price is our close price. So we go in 407. Oops, sorry. We're going to come in here. We're going to take 407, which is our theoretical close price for this video. 407. We're going to multiply that by. Actually, let's just jump up and grab a calculator. Whoops. Calculator. Sure, this is calculator.com. Oh, perfect. Here we go. We're going to take 407. It's currently trading at 407.12. And then we're going to multiply that by 97%. So that's going to be 0.97 in decimal form. And we're going to get 394.9. So again, we're going to round up to the nearest whole number. So that's going to be 395. So the put credit spread strike prices, we're going to sell the 395 and then we're going to buy the one right below it. So we're going to buy the 394. All right, cool. Now we have our strike prices. Next, we need to determine our expiration date. Our expiration date is going to be the current date plus 12 days, then round up to the next Friday. So right now it is March 31st, so plus 12 days is going to be roughly April 11th. Round up to the nearest Friday, that's going to be April 14th. All right, cool. Let's go into a credit spread trade. Let's just start from scratch. All right, this is my small account that I trade credit spreads on. I have my larger account, a 6-figure account at Tasty Trade. But anyways, if we move over here, we're going to go to SPY. We're going to collect SPY options. We're going to go on to Builder. This sets up the trade for us easier. We're going to click on Put Credit Spread. We're going to go to the expiration date that we determined, April 14th. There you are. We're going to go to a width of 1 because that's what this strategy works best on. We're going to scroll down to 395, 394 because that is what we determined our strike price. We're right here. 395, 394 right here. If we click on that, it's currently trading at 14 cents of credit. This is a perfect trade, one you want to place and move on. So what makes a trade a good one to trade? We know how to set it up. We know the expiration date, but what should be the total credit you're trying to target? Well, right here, I didn't leave you high and dry just yet. You want to make sure you're collecting at least a 15 cents in credit. So roughly it's going to be 13, 14, 15 cents is going to be your bare minimum, but anything more will be great. So anyways, you're going to be trying to collect this credit. Why? Because although you have a super high win rate of 92%, if you want to have a long-term positive expectancy and you want to cover your max loss when that occurs, you want to make sure you're collecting 14 to 15 cents in credit. Now again, because it's a strong green day, it's roughly 0.13 cents right now. Yeah, 13 cents in credit. But again, if you're trading this or you're entering on a red day, which is ideal, then the put options are going, the volatility will be a bit higher. And so the premium will be higher as well. And so you can easily collect 15, 17, 19 cents of credit. And that's going to be your ideal sweet spot. But because the market is so green today, it's quite hard to enter on that. Anyways, that is how you put on this trade. This is the true turtle strategy. It works best for uptrending markets. But if you want to know how to define your win rate and make it a bit better, you can add the special entry of criteria. Again, I've been backtesting this strategy for years, and this is the best ways to increase your win rate. Make sure the stock, essentially what this first one here is, make sure that the stock is roughly, the candle for that day is small or slightly red, not a huge green candle. Why? Because it's just harder to get that credit collected that you're aiming for. Number 2 is make sure that the market has been uptrending for at least one candle. So for instance, if the stock breaks in on here, we're not going to buy on here. We're going to wait until it comes down one candle and then buy that, just to give us some confirmation that the market is actually trending up. So that is the best way to place a true turtle strategy to have a 92% win rate. Go use that use the strategy now, and make some money. Join me in my Inner Circle program, and I would love to help you out further. If you're someone who works full-time, the Inner Circle program may be just right for you. So check out my description. Why may it be right for you? Because I show you exactly how to trade credit spreads, even if you have a full-time job and don't have time to place trades during market hours, and I give you access to all my trades that I use use to trade full time. So anyways, guys, this is the credit spread strategy. If you liked it, smash that thumbs up button and the subscribe button. Got a lot more strategy videos coming, and trust me, if you like this one, you're going to like those videos. It's going to show you how to profit in those other phases of the market step by step. All right, guys, see you in the next video. Hey guys, what's up? I want to show you exactly how to have an 88% win rate when trading call credit spreads. Now again, this is all about trading call credit spreads in the direction the stock is going. And so again, I'm going to show you how this strategy works. I'm going to show you the back test of it to prove that it works. Then I'm going to show you and explain the theory behind why this works so you can have an understanding so that you know what you're trading. And then I'm going to show you step by step how to place this trade so that when the market is trending down, instead of losing money, you know what to do to make money. So let's jump into it. How does this make money? Well, you can see here the back test of this strategy, which is called the short play strategy, is an 88% win rate and roughly a 15% a yearly return. Now, again, it does not happen every year. You can see here from the dates, it only happens when the market is trending down, but it also works on DIA. If we come here to DIA, which is the Dow Jones Industrial Average, so you can see another example of what it works with, but it has a 96% win rate. So again, if we're coming into a rough market, you want to be trading SPY or particularly DIA with this short put strategy. There's also other stocks that it works with here as well. And if you want access to any of these back tests, just let me know in the comments below and I will give you full access. But again, this is mainly for Inner Circle members. Anyways, that is a back test to prove that it works. Again, this is all about the theory, which I'll explain here, about trending with where the market is going or trading with the trend. Now, if you don't know this, the market can be in one of three different phases. One, the market can be trending up. That is defined as higher highs and higher lows. Like here, the market is trending up. The highs are getting higher and the lows are getting higher as well. Number two, you have a downtrending market, which is where the market is going down. This is where the highs are getting lower and the lows are getting lower as well. And number three, you have a sideways or neutral market where over months, the market goes nowhere, right? You can see here the highs are roughly the same, the lows are roughly the same. So long term, it's going nowhere. It's pretty flat. It's stuck in a range. The strategy, the short play strategy that we are talking about in today's video is all about making money to the downside, making money when the market is going down. And why is this? Well, because if you're trading a call credit spread, that's a bearish directional play, which means you're betting on the stock to go down, to stay the same, or go up very slightly to make money with a call credit spread. And so when we're hoping the stock will go lower and we combine that with the fact that it's actually trending down, then that's how we're going to make money. Okay? So that is the theory behind it, is when the market is trending down, which again, we can judge by a lot of different factors. For instance, the highs and lows getting lower, or looking at the stock being below the 200-day moving average line, which is this gray line. Again, there's just different ways to tell when the market is bearish, and that's the way you do it. Okay, so now that we know that trading with the trend is the most profitable way to trade credit spreads, let's talk about the specifics of the strategy. So right here is the short play strategy. Again, depending on what you trade, it's going to have roughly an 88 to a 96% win rate. So again, let's just say a 94% win rate. All right, so again, the first criteria for putting this trade on is all about understanding, is the market downtrending? Is the market moving lower? Because if it's not, then we don't want to put on the trade, but if it is, then we will. So anyways, this is all about waiting for it to cross below the red line, which is below here, which is one standard deviation below the 200-day moving average. And so that's how we calculate a short interest or a downtrending market in this back test. All right, number two for the checklist is we need to determine how we're going to set up a call credit spread. What strike price are we selling and what are we buying to protect ourselves? So we're going to take the stock close price and we're going to multiply it by 104%, or essentially just add 4% to the current price. And so what this looks like is this. Let's give an example. Let's say the current trade price is where the stock is, and let's say that the current price is below this red line. So let's just say we have matched the setup for a downtrending market. Let's take this price 407.34. All right, so 407.34 is our current close price for this example, and then from there we're going to multiply it by 4%, or add 4%, which is going to look like multiplying it by 1.04. We're going to create a 423, so that's going to be our sell strike price for our call, or the strike price we're going to sell. And so again, we're going to round up to the nearest whole number, so that's 423.6. So we're going to round up to 424. So that means our first strike price that we're selling is 424, and then we're going to buy the one right above it, so 425. So we're going to sell the 424 and buy the 425. Okay, cool. Now we have our strike prices. Now let's determine our expiration. That's going to be the current date plus 9 days, then rounding up to the next Friday. So the current day is March 31st. So if we round up, that's going to be April 8th. And so again, if we round to the next Friday, that's going to be April 14th, I believe. That sounds right. We'll see. April 14th. Let's just say that's correct. I'm not good with dates. But anyways, you can just follow that method to get there. Anyways, so that is how we find our expiration date. Next, we go to a broker and we set it up. So anyways, I trade credit spreads on both a small account, which is less than 1,000, and also on an account with over 6 figures to show to myself and my members, because on my full account, on my large account, I trade full time, but just to show that it's possible no matter your account size. Anyways, let's go into SPY and set up this trade. So we're going to go into SPY, trade SPY options. We're going to go into Builder to set up a put credit spread for us right here, put credit spread. Click on this. Go to the expiration date we talked about, which I believe is April 14th. It's the next Friday. Then we're going to go to a width of $1 because the $1 width is what works best for this strategy. And then next we're going to scroll up to the 424, 425. I believe that's it, right? Yeah, 424, 425. So come up here. Oh, I must have passed it. Yeah, 424, 425. So right here we're going to be selling 424, 425. Oh, I put, my bad. I'm just going to leave this in there just because you can see that I'm human and make mistakes. That was a put credit spread. We're actually setting up a call credit spread, which is why it was so high. So a call credit spread because we're making money to the downside, not the upside. All right, here we go. Now let's find 424, 425. Okay, 424, 425 right here. 424, we're selling the 424 and we have the 425 as our, oops, we're not on the right expiration date. Whoops, I guess this video is a lot about learning how Austin can mess up. Okay, here we go. The right expiration date, the right width. All right, wonderful. Let's try this again. 424, 425. 424, 425 right here. Currently trading at 8 cents or 7 cents. So this is how you would put the trade on. Now, the reason why this trade works, and you're like, Austin, you're only collecting 7 cents. That's not enough. You are correct. Right here, as stated here, you want to collect at least 15 cents in credit. Now, what the market is not factoring in right now, and what does factor in later, is that right now, the IV rank for SPY, or how volatile SPY is quite low. Why? Because it's trending up. So VIX is going to be lower. When VIX is low, you collect less credit. When VIX is high, you collect more credit. When the market is in a downtrending phase, the implied volatility is a lot higher. So you're going to be able to easily collect 15 cents, if not 20 cents. If we look here on the back test, the average here for a short play strategy on the S&P 500 is $17 to $22 in that range because of how high the implied volatility rank is. So you need to make sure you take that into account. We're looking at implied volatility as well. So anyways, that is the short play strategy. That is how you use it to make money. Now remember, if you can't collect at least 15 cents of credit, then do not trade. All right, guys, that is how you make money to the downside using call credit spreads and the strategy to have a 90% plus win rate or a 96% win rate on the Dow Jones Industrial Average. I hope this made sense. If you have any questions, put them down below. If you enjoyed this video, smash that thumbs up and subscribe button. If you want to get alerts to these trades as they happen in real time as I take them, and also just as they happen on other stocks, you want them via text, email, Discord, whatever, sign up for the 10% credit spreads Inner Circle program, or just click below to learn more. Anyways, guys, see you in the next video. I have so many more strategy videos coming, and I know you'll enjoy it. Hey guys, what's up? I want to show you in this video a strategy that can help you make a 94% return when trading dip buys. This is called the winning whale strategy. I'm going to explain the back test to show you that it works. I'm going to explain the theory behind it so you understand why it works. When you're trading it, you're like, oh yeah, this makes sense. And then I'm going to show you step by step how to place this trade. So step number one is, what is the back test? You can see here with SPY, or the S&P 500 ETF, we have a 94% win rate with a 63% yearly return. Now, again, this trade does not happen every single day or every single week. Maybe once or twice a year do we get a string of these trades. Now, again, that's because it's a dip buy strategy. So that means the market needs to sell off in order for the strategy to happen. But I'll explain more about that in the step-by-step process. All right, so you can also trade this on DIA. If we go to DIA, you can see it has a 93% win rate, and you can also change it for other stocks as well. TLT will typically have more occurrences, but again, you can see here, but again, your win rate is a lot lower with that. Anyways, you can make the stock you want to trade on, but SPY and DIA tends to be the best stocks for this strategy. Okay, moving in with the winning whale strategy with a 63% yearly return, I'm going to explain the theory behind why this works. Also, quick side note, if you want access to the backtest, you can become an Inner Circle member, or just leave a comment down below and I'll send you a CSV file of the entire backtest if you want it. Okay, so if we see here, the way that we structure this trade, or the way that this trade works, is what the winning whale is. So if you never heard of a whale in the market or in the trading game, a whale is somebody with a ton of money. It's typically a hedge fund, a bank, an institution, or something like that, which has enough money to move the market. It also could be insider traders like the CEO or the CFO who buys or sells a large portion of their company's stock because they know something. So this typically happens around lows. When the stock reaches a low, then you'll see the CFO of a company or a big institution buy a large portion, and then it'll trade up. And so that's what this winning whale strategy is. It's buying the dip, but also knowing how to buy it. So again, when you're trading put credit spreads, your whole goal is to make money on the upside, right? A put credit spread makes money as the stock goes up, as it stays the same, or goes down a little bit. And so when we're trading put credit spreads, we're looking for an opportunity for the stock to move higher. And with dip buys, that's the perfect opportunity. So that is the theory behind it and why this works. Now, to explain the strategy step by step, this is how it works. First off, we want to make sure that the stock is bouncing. That's what this criteria is right here. It says, is this stock bouncing? And so what it looks like is we're waiting for the stock to go below this bottom yellow line, which is 3.8 standard deviations below the 200-day moving average. Once it breaks below that and then breaks back above and closes above it after being below it, that is our dip buy entry, and that is what satisfies this as a dip buy. Because statistically, when that happens, the stock recovers shortly after. So that's what the setup is. Now we need to determine our short strike price for our put credit spread. So that's going to look like this. We're going to take the stock's current close price and multiply that by 96%. So let's say this was our entry right here, because this is where it closed back above. So if our entry is right here, then we're going to take let's see what the close was, 365.97. So 365.97 times 96%, which we can see here, 96%. So we're going to multiply that times 0.96, and that's where we're going to get our short strike. Now we're going to round that. It says 351.33. We're going to round that to the nearest whole number. So we're going to say 351. So our goal is to short the put contract at 351 strike and then buy the one right below it at 350. So that's how we're going to set up our put credit spread. Now again, this is an example way below where the stock currently is, so it's going to be hard to set that up on a real example. But before we do, we need to determine our expiration date. Our expiration date, again, this is the best expiration date based on the strategy being optimized a lot of different times, is 14 days. So what you do is you take the current date, which is currently March 31st, you add 14 days, so April 13th, and you round to the nearest Friday, which would be April 14th. So again, we're going to go and we're going to set up this trade. You can see here we go into Robinhood, we go to trade SPY options, we go into builder, we go into put credit spread, because that's the spread we're trading. We're going to go into the expiration date that we determined. So it's going to be April 14th, just like that. Now again, we're probably not going to be able to find the exact strike prices of what we found because it's way lower than where the price currently is at the moment. So we would need to go all the way down to, what was it? 353? Yeah, 351. So yeah, it doesn't go down that low on here just because there's no value in it. But again, that's because we're not near that. We were just giving an example from way low. It's currently trading at 408. Anyways, that's the example of how you would set up the trade. Now, the next thing you need to know is that you want to collect at least 15 cents in credit. Now, what you do have going for your advantage that is not shown here is when you're trading like this, when the market is dipping down to new all-time lows or lows that it has been to in roughly a year, then your IV rank is going to be very high. When your IV rank is high, you can collect more credit. So your goal is to collect 15 cents minimum, but you should be able to easily collect $20 to $25. You can see here the average, roughly $22 to $26 in credit, and that would be an amazing credit because the IV rank is very high. Anyways, that is the idea of buying the dip and using put credit spreads to profit from it. So if you're someone who wants to take advantage of this, make sure to click the link below to check out this article that lays it out step by step, so that when a dip comes, you know how to profit from it. If you want these alerts sent straight to your phone via text, email, Discord, whatever, then check out the 10% credit spreads inner circle program, where I share my personal trade alerts, where I trade for a full-time job. That's what I do with credit spreads and other things like that. So if you want to learn more, smash the thumbs up button and smash the subscribe button, because I have more strategy videos coming. I hope this makes sense, and I hope this helps you profit using put credit spreads. Hey guys, what's up? In this video, I want to show you how to have a 94% win rate trading put credit spreads on a dip buy bounce strategy. So this strategy, I call it the elastic bounce, and I'll explain more of why that is. But to give you an understanding of what's being covered in this video, is I'm going to show you a back test so you can see that it works. Then I'm going to explain the theory behind it so that it makes logical sense, so that you understand what you're trading. And then the third step is I'm going to show you step by step how to place this trade so that you're ready during the next crash. All right, so let's jump into it. The back test here, oops, that's the step-by-step. Back test first is right here. So on the S&P 500, you have a 94% historical win rate since 2003, with an average of a 62% yearly return. Now, we're looking at this trade right here, and you can see you're collecting roughly $29 to $30 per spread, and that's because of how high the IV is. So the reason why this works well is because during a period of a crash, for instance like this, when the market is dipping low, your implied volatility, or VIX, is going to be higher than it typically is. So that's just a caveat that I wanted to share. That's why it works out so well. Anyways, but you have the 94% win rate, so regardless, you're doing well. Anyways, this is the back test. This is your yearly return, and this is your return since 2003. You can see here you do have streaks of losers. It does happen, but again, it's very rare, and you'll understand why when I explain the strategy. If you want access to this backtest for yourself, just comment down below and I'll send you a CSV file of the backtest. But to explain why this strategy works, it's quite simple. If you've ever had a rubber band and you were stretching that rubber band out so much that it snapped, that's exactly what is happening in this strategy. That's the theory behind it. You have a rubber band, which is the market, and the market is getting so overextended, meaning that the market is going outside of its reach of how far it should normally go, that it snaps back into place. So that's what happens here. We're basically creating on this chart a normal distribution. If you've never seen that, that just shows how much price should fluctuate. And so you can see here, this is the middle. This is our one standard deviation. This is roughly 3.8. So you can see here, once we get outside this 3.8 range, the rubber band is so extended that it's just ready to snap. So once we get into below this range, it's just going to snap back. You can see here it snaps back. You can see here it snaps back. You can see here it snaps back. Just historically, that's what happens. And so that's the idea that this trade is based on. A rubber band snapping is the stock going outside of its range and snapping back, also known as a mean reversion strategy. So anyways, let's show you how to take advantage of this trade. So here's the step-by-step steps to take advantage of this strategy. If you want to check this out for yourself, feel free to click the description below. This is an article I wrote on the strategy and why it works. Anyways, first off, you want to wait for the stock to cross below the bottom yellow line, which is 3.8 standard deviations below the 200-day moving average. You want to wait for it to cross below this yellow line, which is exactly the math I just showed you. So once it's below that, then this trade entry is satisfied, and we start to enter using the rules here. So we're placing a put credit spread trade, which is a bullish strategy, and we need to figure out where our short strike will be. So first, we need to take the stock close price and multiply that by 0.9. 0.96. So for instance, let's say we're trading this example right here. This was the first time it closed below. So again, the close price right here is 36431. So let's go here, 364.31. We're going to multiply this by 0.96 or 96%, and we're going to get 349.7. Now we're going to round to the nearest whole number because again, you can't trade credit spreads on strike prices. That's 0.7. So round to the nearest whole number. That's how this back test was determined. So you have a strike price that you're selling of 350, and then you're going to buy the one right below it to protect yourself to the 349. So that's how we set up a credit spread. Next thing we need to know is what is our expiration date? Well, our expiration date is going to be the current date plus 14 days and then rounding up to the next Friday. Now, again, this date has been tested, but it works best for 2 weeks. Why? Because when we're extended in this range, it typically does not stay below this range for more than 2 weeks. And so that's why this trade works. Now, again, the string of losers you saw was from 2008, a super large guy. As you can see here, it breaks through and then snaps right back up. It breaks through and snaps right back up. It breaks here, snaps up, breaks here, snaps up. It doesn't stay down there longer than 2 weeks, except for when we get into these ranges right here for 2008. But again, that doesn't happen all the time. Regardless, you have a 94% win rate, so your wins will outweigh your losses. Anyways, that's just an example that I wanted to show you. So now that we have our expiration date, which is the current date, so again, if we were to structure this now, for instance, it would be today's date is March 31st plus 14 days. That'd be April 13th, and round up to the next Friday, which would be April 14th. So that would be our expiration date. So we're going to set up this trade in a broker. This is not something I can really do here because the example that we use, the strike price, you can see here, 350 is too low to take advantage of. But you're just going to go to Builder. You're going to go to Put Credit Spread. You're going to go to the expiration date that you determined, April 14th. You're going to go to a width of $1 because that's what works best for the strategy. Then you're going to go and scroll all the way down to the 350 strike price with 347. So 350,349. And then again, you want to collect right here at least a 15-cent credit. Now again, that should be possible with a high IV. But again, that's exactly what's going on here. Make sure you collect at least 15 cents in credit to have a long-term expected or positive expectancy. Anyways, that is this dip buy strategy. If you want the alert sent straight to your phone, straight to your email or Discord, when this setup happens, you can join the 10% Inner Circle program. You get alerted to all the best trades that have over 90% win rates as they occur, and also my alerts that I personally trade with these credit spreads on both my 6-figure account and my small account, which you just saw on Robinhood. Anyways, guys, thank you so much for watching. If you like this video, if you got value from it, smash that thumbs up button, smash the subscribe button. I have more strategy videos coming, and so if you hit the subscribe button, you will get notified of the next one. All right, guys, see you in the next video. Hey guys, what's up? In this video, I want to show you how to make money trading call credit spreads and have a 90% plus win rate. So again, I'm going to explain one, the back test, so you can understand this strategy. Number two, I'm going to talk about the theory behind it and why it works. And then I'm going to show you step by step how to place this trade so that you're ready the next time this trade setup comes. So first off, let's look at the back test. So this is called the elastic rejection strategy. I'll explain why I gave it that name in a second, but you can see here you have a 95% historical win rate since 2003 with a 65% yearly return, which is insane and really good. Now, if we're looking at this return, you can see here we're going to collect roughly $19 in credit to $21 in credit, somewhere on that average, and that's how we're going to make this return. Now, again, this is a call credit spread trading strategy, so you're making money to the downside or hoping the stock moves lower. Now, let's talk about the theory behind this strategy. So the theory comes up like the elastic bounce strategy that I mentioned in the last video, the last strategy breakdown. What happens is a rubber band can only stretch so far, and then once it's reached its breaking point, it snaps. And so we talked about that during the bounce one, where it's reached its low, it can't go any lower, and it snaps back up. Well, the same way that it happens to the downside, it happens to the upside. When we get to above a certain level, the stock just can't hold that. It's too high. It's too far above its range, and then it just snaps back. So again, that is what this snapback is, the elastic rejection, where it pushes up to a level that it cannot sustain, and then it rejects back down. It doesn't always turn into a full-fledged crash, but it does at least pull back enough for us to make money using call credit spreads. So that's the theory and the idea behind the strategy. Now, how to put on the strategy is like this. One, we need to make sure the stock is reaching an elastic rejection point, which means that the top yellow line is above 3 standard deviations above the 200-day moving average. So you want to make sure you're waiting for the stock to get up outside of its 3 standard deviation range. After that, then again, we need to determine what our short strike price is for our call credit spread. So we're going to take the stock close price and multiply it by 103%, or simply add 3% to the stock close. So what that looks like here, if we're giving this example where it broke above it right here or here, let's just say here, the close price for here is 332.86. So 332.86. So if we go 332.86, and then we add 103%, which turns into 1.03, then we get 342.845. Now again, we round to the nearest whole number, so that's going to be 343. So that is the call strike price that we're selling. And then we're going to have to buy the one above it, so that means 344. So again, we're going to sell the 343 and buy the 344, and that's what our call credit spread would look like. Now we need to determine our expiration date. According to the back test, and found the best days for this is 19 days out. So take the current date plus 19 days and then go up to the nearest Friday. If plus 19 days ends on Friday, perfect. If it's not, then round up to the next Friday. Next, you want to set up this trade. So again, it's going to look weird to set it up here because we're talking about levels that SPY currently is not at. So it's going to be hard to do that, but I'm still just going to try my best to show you an example. You're going to go to Builder, then you're going to scroll down here to Call Credit Spread because it's a bearish move. You're going to put on a Call Credit Spread. You're going to go to the date discuss. So say roughly April 21st. I don't know. This is just a guess. And then again, you'll use the call where I said, what was it? It was a 343,344. So 343, let's see if we can get this. It's probably not. Yeah, we're out of range. But yeah, a 343,344 is what you'd be looking for, and looking to collect at least a 15-cent credit, right? Right here, you want to collect at least 15 cents in credit. Now again, this is going to be the ideal range, because if you want a long-term positive expectancy, you need to at least collect 15 cents in credit so that your wins will offset any max losses that do occur, since this is a set it and forget it strategy where you plan to hold until expiration. So anyways, that is the strategy to make money using the elastic rejection strategy. If this made sense to you, if you liked it, if you want to use the article, or if you want to check out the step-by-step tips, check out the article linked below. If you want access to the backtest, just comment down below and I'll give it to you in a CSV file. Anyways, if you enjoyed this, please press the thumbs up and subscribe button, because I always have more strategy and helpful tip videos coming if you want to trade credit spreads. If you want access to alerts being sent straight to your phone via text, email, and Discord when this trade setup happens, as well as the other ones that I trade, then make sure to join the 10% Credit Spreads Inner Circle program to join me and get my alerts and training and everything to help you become a full-time trader, as well as grow your account even if you work full-time. All right, guys, thank you so much for watching this video. I can't wait to see you in the next one.